Thank you again, once again. Good afternoon, ladies and gentlemen. Delighted to have you from the Institute and the Uganda Bankers Association. We do not take your presence lightly. We sent you a call, many of you have responded, and now we are here, so we shall start our webinar. My name, once again, Goreti Masade, and I'm the CEO of the Institute of Banking and Financial Services. And today we have a very distinguished panel of discussants that are going to help us digest this topic of financial inclusion in the era of disruption, achieving sustainable growth. We all know how important this is, especially for our country, for our economy, and of course the people that we serve. Before we start, allow me to introduce to you the Institute a little bit. We've also gone through our fair share of challenges, just like anybody else, but we just like to update you as to how we are doing and how you can engage with us. So friends, the Institute of Banking and Financial Services has got a number of partners, some of them being the Global Banking Education Standards Board, others being the London Institute of Banking and Financial Services, and so many others that we actually deal with to ensure that we deliver to you quality products and services. Our vision is a Center of Excellence in Financial Services training. And then, of course, our mission is promoting professionalism and inclusion through market-led training, research, and consultancy to providers and users of financial services.
Sorry, you're on mute.
So what distinguishes us is we've got a brand, 25 years of experience, a sizable pool of trainers comprising of mixed academics and industry practitioners. And we've got links with the industry, with members who are actually our members, providing ground for internship and projects. We've got a recognized certification and award structure. We are the sole provider for certified professional banking courses in the country. And then professional training with emphasis on applied knowledge and skills. We also have a robust quality assurance structure, including accreditation with the National Council for Higher Education, regional and continental affiliations. Just a moment. When COVID, as the slides run, we have a little bit of a challenge here, but as the slides run, with COVID, what we have done is enhance our e-learning platform. We've got a very robust e-learning platform. And on the platform, you will receive a number of functionalities. What is happening is we are able to get our trainers give assignments to students. Our students are able to chat with the trainers as the training goes on. Our trainers are able to give quizzes, a general quiz, and then get or receive individual student responses. They're able to do polls, a bit similar to Zoom, but this is in a different way. They are also able to create a database or a file of all the researches that they do. They can actually work within the platform, but also go out and research and get that information back and have their own files and folders that are customized to them. We also do video. Of course, they'll do video instruction and recording that they can actually get back to. There's quite a lot that we can do, and at the moment, we are also making it available to institutions, other institutions, if you know institutions that may need a proper, robust e-learning platform. We are doing that now, and we are ready for talks. We've got quite a number of programs that we have come up with in response to COVID. Some of them are in partnership with the London Institute of Banking and Financial Services School. And what they've done is to come up with digital courses that are at awareness level, at management, middle management level, at senior management level. And all these courses are geared to help us understand and appreciate how to work as financial institutions in this particular era. And so we shall be sharing a lot of those with us, with the membership, and hopefully you can choose what is really relevant to you. In terms of delivery, very recently the Ministry of Education sent out guidelines. So in this coming week, we shall be making a formal application to start face-to-face instruction. But right now with our e-learning platform, we are able to offer you live training on the e-learning platform, but at the same time, you're able to have self-study. You can do self-study on the e-learning platform. But as I said, we are also exploring a mix of face-to-face once we get the applications confirmed. Having said that, for those that choose a self-study model, we are also able to give you on demand, if you make a request for a live session within your self-study program, that too can happen. We would like to inform you that for our academic and professional program, Chartered Banker program, Master's program, postgraduate diploma programs, we are starting the semester very soon in August. And so if you'd like to come on board, it's get in touch with us so that you can enroll. Examinations are scheduled for around December of this year. And so it's important that if you would like to retool, reskill in this period, you get in touch with us. Finally, we just want to tell you, inform you, all our members, that we have an AGM coming up next week on Friday, 17th of July. It will start at 9 a.m. Very important resolutions to make in the AGM. We have change of board members. We are filling vacant positions on the council. At the same time, we have proposed to you a membership restructuring plan that is going to enable us align experience, knowledge, skills to career. And so it's important that you listen to this as part of the AGM and we approve it. And lastly, because of the challenges that COVID has presented to us, we are having the meeting as a virtual meeting. And then there will be so many other things that are likely to change. Because of that, we shall be changing our memorandum and articles of association. So that is one of the other elements that you will need to be part of as membership. And so we request you to engage, to register. Registration has been sent to you. Register for the AGM and let's meet. Ladies and gentlemen, thank you very much. So that's that for us about the Institute. And now I would like to introduce our dear panelists to us. I'm sure you all received their profiles as you registered, but let me take the honor and pleasure to introduce them briefly. And I'll start with our keynote speaker, Dr. George Wilson Sonko, who is the head of Financial Consumer Empowerment Mechanism at the Bank of Uganda. Dr. Sonko received his doctorate in business administration from Nelson Mandela Metropolitan University. And during his student days, he received numerous awards and scholarships. He has taught at various national and international universities, and is still an adjunct lecturer and external examiner for several higher learning institutions. Please welcome with me, Mr. Sonko, Dr. Sonko. And then we have Rashmi Pillai, who is the executive director at FSDU, And she leads the strategy and stakeholder relations program implementation, impact measurement and research at FSDU. Rashmi, we are very delighted to have you. Thank you for joining us. Mr. Wilbur Dowo, you may know already, he's the Executive Director at the Uganda Bankers Association. Very strong in strategic management and has got a bachelor's degree in commerce from Makerere University, and his master's was at ESAMI, and he has been working in the banking sector for quite a while. That is over 25 years working experience. We thank you very much, Wilbrod, for joining us. Mr. Kaumi is the General Manager for InterSwitch, but also the Chairman of the Association for Fintechs in Uganda. Thank you very much, Peter, for joining us. At this point, ladies and gentlemen, allow me to hand you over to our keynote speaker. George, are you ready?
Good afternoon. The Chief Executive Officer, Uganda Institute of Banking and Financial Services, the Executive Director, Uganda Bankers Association, our moderator this afternoon, Mrs. Goreti Masade, who is the CEO of UIBFS, the panelists, we have Ms. Rashim Pillai, who is the Executive Director, Financial Sector Deepening Uganda. We have Mr. Wilbur Dowo, who is the Executive Director, Uganda Bankers Association. And then we have Mr. Peter Kaumi, who is the Chairman of p60 and also the General Manager of InterSwitch. And of course, I recognize all members in the audience, the corporate and individual members of UIBFS, and all distinguished invited guests, ladies and gentlemen. This afternoon, I've been asked to talk about financial inclusion in the era of disruption and how it's likely to shape economic growth or economic mobility going forward. There are a number of things that are key that we need to appreciate, that when you look at the economic environment, the issue of disruptions is becoming more frequent, they are becoming more intense, and they are becoming very costly. We can broadly talk about disruptions in about 3 or 4 categories. The first category is to look at climate change-induced disruptions. And those include things like environmental disasters, massive earthquakes, we talk about tsunamis, we talk about all these floods. Those are climate change-related disruptions. But also in the climate change-related disruptions are issues to do with the health-related disruptions like the current one we are undergoing. The fact that now viruses that used to live amongst animals are jumping and now they are being transmitted to humans, what we call zoonotic diseases. There are also other disruptions like financial crises or economic crises. There are also other disruptions to do with technology. Some of them are positive, some of them are negative, and there are also those disruptions that are being necessitated by the geopolitical dynamics of the world. For instance, the crisis between Iran and the United States in the Middle East. We are talking about Chinese trade wars, and all those disruptions can create a number of problems that affect the economic system and consequently affect financial inclusion and later on economic mobility of the citizens. But my main point there is to emphasize that when you think about disruptions, they're becoming more frequent, they're becoming intense, and they're becoming very costly. When we look at financial inclusion, we should perceive financial inclusion as an issue of affordability, quality, access, and usage. What am I trying to say? That businesses and households should be able to access affordable services, use those services, but those services must be quality services. So what happens is once disruptions come in, they are going to affect the way the financial ecosystem provides these services. When we talk about the issues of product, we talk about the issue of place, we talk about the issue of processes, the issues of physical evidence of whether the service has been provided, the issue of people. What is the attitude, knowledge, and skills of the people when they actually are engaged with these financial services? So one of the things that ideally happens is that disruptions will have an effect on the way financial inclusion at its very basic of accessibility is actually perceived. So that's very important to appreciate that when you talk about disruptions, they are going to impact the financial inclusion through a number of the what we call the 7 P's in marketing, that you are going to see the product has to change, the issue of place of delivery of the product, the issue of whether the people that are delivering the product are actually changing, and all those other aspects. But over and above that, we need to appreciate that usage of financial services amongst Ugandans, even before COVID-19, was actually a very big issue. We see that on average, while we see that access has been high, for instance, I can say we have about 27.7 million mobile money accounts. However, if you see the active accounts over a 90-day period, you'll see that we are actually talking about only 17 million. So the other 10 million actually have the mobile money account but are actually not using it. And if you do not use these mobile money accounts, the danger is it can either become dormant, but it's also not facilitating your economic mobility as the individual. So what has happened that initially access meant that people would get to transfer what we call monetary value transfer money from one point to another, and probably also buy airtime. But if there is no usage, these users or these people who have actually had access to financial services then don't move on to the more advanced products like, say, microcredit, microinsurance, and all these others. And that's a very big thing that disruption can actually impact. That initially we had a situation whereby people used to access the services, but the usage was low. So what has happened with disruption, that disruption further lowers the usage of some of these financial services. So that's the other thing that happens with disruption. And of course, on the side of the financial services providers, because when we talk about financial inclusion, we should look at it from both the supply side and the demand side. The supply side, we have to look at the financial services providers that have to deliver these products. So on the side of the financial services providers, what disruption does is, unfortunately, it impacts both the asset and the liability side of their balance sheet. So one of the things that disruptions do to financial services providers, that they make them rethink their business models. Because you see, our business model before COVID was, I want to access financial services, I go to a traditional brick and mortar financial institution and either use my ATM card, ask cash across the counter. But now all of a sudden, with the national lockdown and social distancing measures in place, some of these things you cannot access. So in terms of business models, then these people have to change the way they're actually doing their business. And we start to see that digital financial services start to push out the traditional way of delivering services. Then the question is, do we have the necessary infrastructure in place to support the increased usage of digital financial services? Do we have the appropriate people skills, the knowledge, the attitudes of the staff to be able to deliver financial services? These are things that we need to think about as our business models are actually forced to change because of the disruptive force of issues like COVID-19. So people in the financial services space need to start to think about whether their business models are actually viable or they are no longer viable. Of course, the other issue that is very important to think about when you think about disruptions and how they impact financial inclusion and economic growth is the issue of whether a disruption is systemic and whether a disruption is localized or idiosyncratic. If a disruption is systemic, like the current COVID-19, that means thinking about the way of overcoming disruption in a silo becomes a very big problem. You cannot deal with a systemic problem using compartmentalized solutions to your problem. So because this is a systemic disruption, the methods that we need to deploy need to be a little bit more inclusive and holistic, and actually there has to be some collaboration across players to be able to save the financial industry as a totality, but also to safeguard the issues of the financial consumers that have to use the financial ecosystem. Short of that, if we don't think of collaboration for a systemic disruption like COVID-19, the danger is we shall push out some individuals, push them to extreme poverty, and then we shall lose customers as the financial system. So really, we need, when I think about what needs to be done to safeguard the safety of the financial system and the ecosystem going forward, of course, the first thing that comes to mind, because this COVID-19, this particular one, is a systemic disruption, the government has to play a very key role in terms of what needs to be done to safeguard the system. And of course, government has a number of policies it can call upon on. It can call on its central bank to implement its monetary policy, and the central bank has obliged. It has actually undertaken what we call expansionary monetary policy. We've seen the central bank rate lowered, so that has an impact in allowing low interest rates to permeate through to the real sector of the economy, and individuals access money at a low interest rate, and then we see some kind of multiplier effect going into the real economy. The other thing, the central bank can call on its financial stability policies. It can provide, and it has indeed provided, a liquidity facility to be able to avail still low interest money so that it can go into the economy and do the needful. And also the state has also put some money in the national budget to help micro, small and medium enterprises to overcome this shock. Some of it has been put under SACCOs, some of it has actually been put in Uganda Development Bank, and we see that these fiscal policy measures should be able to allow people to move on with their lives as best as possible, or to bring their lives back to the pre-COVID levels. But also, even if these systemic things are being done, even us in particular ways, financial services providers and even financial consumers need to be able to take some steps to actually safeguard themselves from the effects of the systemic disruption that is happening. Of course, in terms of financial services providers, the first thing you need to think about is the issue of business continuity and risk mitigation. So, safeguard your customers, put measures of social distancing in place so that they don't contract the disease of your premises, put measures in place of credit restructuring. I know the central bank has given you guidance, but you can go ahead and actually push this, and then do all those other things that protect the integrity of your business. But at the end of the day, you must not forget that you need to preserve the customer, so your consumer protection measures should also be at their best. And then finally, for the financial consumer, it is imperative that you understand the challenges that you are faced with in these COVID-19 issues. Please patronize the credit relief measures that are being provided by the commercial banks under the guidance of BOU, so that you avoid negative information accruing on your credit reference bureau card. You avoid going into default, which will translate into you being credit rationed out of the market. And then ultimately, think about what business models you can continue using so that you can continue earning an income during this COVID-19. I thank you and I submit.
Thank you very, very much, Dr. George, for that insightful beginning of this discussion. Unfortunately, again, we were a bit challenged with technology. Again, speaks. I hope not so many people have been excluded from this particular section of the discussion, but it speaks to the challenges that we have got to deal with. Under normal circumstances, we should be together in a room. You've talked about a number of things. You've talked about business models. You've talked about SMEs. You've talked about for affordable financing. You've talked about collaboration and a number of things, and new things like products and green financing, Islamic financing, a number of things that you've talked about that we should be thinking about. And at this point, I would like to get to our panelists and ask them to tell us a little bit about their organization and what they are doing in terms of financial inclusion before we get to reacting to the keynote address. So I'll start off by asking Wilbrod from Uganda Bankers Association. Kindly tell us about the organization and what you're doing in terms of inclusion. If Wilbrod is not on yet, I'm not sure he can hear me. Rashmi, could you please start us off?
Sure. Hi, Goretti, and hello, everyone. My name is Rashmi Pillai. I'm the Executive Director of Financial Sector Deepening Uganda. FSD Uganda is the country's leading institution on financial inclusion and inclusive financial market. We provide technical assistance and catalytic grants to enable innovation and scale. We also do a lot of research, policy analysis, and evidence-based to enable policymakers to make evidence-based decisioning. We support the private sectors, a lot of them being bankers, insurance providers, including mobile money and fintech operators, by giving them de-risking and experimental grants to push the frontiers of product development, service delivery to reach the bottom of the pyramid, as well as underserved people in the country. And of course, we have a particular focus on women, refugees, youth, and smallholder farmers. That's a short and brief introduction about ourselves, and very excited to be here.
Thank you very much, Rashmi. New learning there, but very glad to have you on this panel. May I now request Peter? Peter, kindly tell us more about InterSwitch and FITSPA.
Thank you. Very good afternoon, Goretti. My name is Peter. Before I get into that, first of all, congratulations on the recent appointment to the Institute. We're really excited to have you on board.
Thank you.
So my name is Peter. I currently serve as the General Manager at InterSwitch here in Uganda. InterSwitch is a multi-country but sub-Saharan payment processing firm. Many of you on this call will know a lot about what we do in ATM switching and things of the nature. I also chair the FinTech Association. We call it FITSPA, Financial Technology Service Providers Association, which is the reason I'm here today. FITSPA is an independent, non-profit, membership-based organization that was formed 3 years ago with support of FSDU and UKAID to represent the interests of fintechs in Uganda. Now, many of you will have heard about the growth of fintechs and the opportunity that fintechs present to the financial services industry and in delivering the goals of financial inclusion. Today, we are very vibrant in the financial sector. We've got over 100 members and are processing about 2 million transactions a day right across the sector. Apart from supporting the growth of the sector, we also support them in engaging with regulators. So for example, we were very recently involved in the formulation of the National Payment Systems Bill through engagements with the Parliament and the Bank of Uganda. And we're supporting them to form partnerships, for example, with UBA, with the Institute and others. It's a really exciting time for the fintech sector because we're growing quite rapidly. Everybody is talking about fintech and the opportunities it presents and the different business models that we are approaching financial services with. So we're really excited to share our thoughts and experiences here. And thank you for the invitation.
Oh, thank you very much, Peter. Rashmi, kudos to you. We have FITSPA on board because of you. Thank you very much. I think that's evidence of the work that you're doing. Wilbrod, I can now see
Hello.
you. Yes.
Hello, good afternoon all. Wilbrod is my name. Sorry, I was wondering why you couldn't hear me. The Uganda Bankers Association is the umbrella body for the supervised financial institutions regulated by Bank of Uganda. Our membership is made up of 38 members. We have all the tier one, the 27 tier one banks, as well as 2 development banks, that is Uganda Development Bank and the East African Development Bank, and also the tier 2 and 3 post bank, Finca, Pride, Ugaford, Mercantile, BRAC, and so on and so forth. The umbrella body really is to drive across the interests of the various financial institutions, promote initiatives, work with the regulator, all meant to grow the industry and, of course, serve our stakeholders and customers and keep improving that service to them, including the offering. UBA or the membership of UBA are primary partners of government in the financial inclusion agenda, together with all the various actors and players, including fintechs, including development agencies like FSDU, who we work very closely and supported by the infrastructure provided by telecoms to extend services across the country and promote penetration of financial services. So this is a subject that is at the center of our heart. We are very interested parties. Looking forward to sharing quite a bit in the discussion. Thank you very much.
Thank you very much, Wilbrod. Now, to go back to Doctor's presentation, he introduced financial inclusion to us, but what is seeming really obvious now is that perhaps with the disruption, there might be different ways that we may be defining financial inclusion. And I would like to hear from Rashmi, especially because you're very close to that work, research and everything. In your view, tell us what you think financial inclusion really is.
Sure. Thank you, Goretti. I have realized that you're kicking us off with a controversy because how we see financial inclusion has changed over time. So let me give a little bit background on that. All of us, including FSD Uganda, central bankers, all banks, as well as institutions working tier 4 sector, initial thinking a decade ago has been focused on access to financial services. That includes access to cash in, deposit and withdrawal points. It includes access to an opportunity to store of value, which is savings or credit. Over time, what we have, and the hope was the greater the financial inclusion as defined by access, there would be opportunities for people for economic mobility to move upwards and increase their take-home incomes, because you're deepening your relationship with the financial sector. Therefore, you can do other kinds of economic activities, protect yourself through insurance, take credit, etc. Unfortunately, if you look at statistics from the East African region, as the traditional definition of financial inclusion increased, mostly driven by mobile money, there has also been a corresponding increase in poverty rates. So the original idea that financial inclusion could actually decrease poverty by enabling people to use different financial products and services did not necessarily work. This is not to say that our traditional thinking is wrong, but what we as FSD Uganda have concluded, and I'm sure there are certain people on the panel who will agree with me, is that traditional approach is necessary, but it is not sufficient in of itself. The reason I'm saying that is because there is no point having a lot of bank accounts opened and then they end up being dormant. That is not good for any bank or the financial sector. People need to have money in their pockets before they can open a bank account. Otherwise, the cost of a bank account becomes prohibitive. That is why we see a lot of people in Uganda, including some of the richest, having a lot of working with SACCOs, working with VSLAs, because the cost of savings and credit, not only it is very fast, it is also cheaper. So the the point I'm trying to make is financial inclusion as defined by the supply side of access is partial. It's a partial definition. It is insufficient. And most of the gains in financial inclusion in Uganda came from payments. They came from mobile money transactions. It was easier for people to deposit, but that's not financial deepening, where we want people to be able to access credit. We want people to have greater insurance and be able to save for their old age so that they don't go back into old age poverty. And that's the kind of discussion we need to be having, including what is the role of the financial sector in enabling greater take-home incomes for people. How are we helping agriculture? How are we helping people in manufacturing, in the real economy? And are we using digital technologies that are coming out of members like p60 to rethink our business models?
Thank you, Rashmi. Now that you've actually talked about friends and colleagues like partners like p60, I'll probably ask Peter. Peter, do you have anything to add to that description?
So you will not be surprised to hear that I completely agree with Rashmi. So many of the fintechs across the world, not all, but many of the fintechs across the world do not rely on any sort of funded income to make money, for their business model to work. So yes, we do have digital lenders and the like that do, or people dealing with the capital markets that do, but most fintechs and enablers of the financial services sector using technology make their money from transactions. So we believe that of what use is a bank account or a wallet to you if you cannot use it, or it is not accessible to you, or it is not relevant for you. And we believe that if it is not these things, accessible, relevant, then you will not use it, and hence the dormancy that Rashmi was referring to. So we believe that financial inclusion has quite rightly moved from accessing and opening that wallet or bank account to how often are you using it? Are you using it on a daily, weekly, monthly basis? And is it delivering the value that you expect of it in a safe manner, in a manner that you understand? And is it helping you move from poverty to a place where you can be economically active in the country?
Thank you. Thank you very much, Peter. We've now heard from Rashmi, FSD, you giving us data. And then you have talked to us as a fintech or representing fintechs, and it sounded very much like an intermediary enabling transactions. Yes, rightly you've said that there's digital lending coming on board, but for now it sounds very much like intermediary. Now from the real suppliers, Wilbrod, do you have a slightly different description? What do you see?
Thank you very much, Goretti. You will be surprised, like Peter said, we shared thoughts based on what my colleagues, both Peter and even Rashmi, has said. Let me come from the background that perhaps the initial definition was limited and narrow to just accessing either a bank account or being able to transact using mobile money. I think beyond that now, clear, we all agree that the definition should go beyond that and talk about the underlying, economic activity that supports those millions of users that perhaps
Sorry, Wilbrod, we've lost you. Are you still with us?
Yes.
Okay.
Sorry about that. Sorry about that. I hope you can hear.
Now we hear you. Now we hear you.
Thank you. Sorry about that. So I was saying I agree with Rashmi that the definition of financial inclusion is now just beyond having a number of accounts or accessing a phone to do mobile money transactions. It's really more the underlying economic conditions and activity of the last mile person down there who was previously excluded from the formal financial system, and how they use the money to trade, to undertake the economic activities that maintain their livelihood. Having said that, and having listened to the keynote speaker, there are a couple of things that come to mind in terms of where we are and what are the things we still need to do. A lot is changing. Thanks to technology, it has enabled reach and access in a far cheaper model than it used to be, and able to reach millions and millions of people. That has made it easier, although there's still a lot of work. There are now issues about the type of products that speak to those who were financially excluded previously, and how do we bring them into the formal economy. There are beginning to be issues of affordability of those services so that they can actually afford them, they address their needs, the depth of those services. Those are important things, and some of them speak to policy. But I think there has been good progress, even from the initial narrow definition. Just using the basics without going into a lot of detail of that mobile subscribers, I think the numbers are now at 28 million. Accounts, just bank accounts. And again, there's a quick disclaimer that number of accounts does not necessarily mean the number of people, because each one of us could either have 2 phones or 3 phones, or indeed 2 or 3 bank accounts. But as I speak, as at the end of December 2019, the banking system in the country had 15,423,426 accounts. So there are 15.4 million accounts compared to 7-8 million that we used to have a couple of years ago. And again, thanks to technology that has been able to reach numerous people, including working with the MNOs to enable certain services be offered via the phone. Interesting in these numbers is that out of those 15.4 million, and this really tells you something about inclusion, what inclusion means. 14.7 million of those 15.4, by the end of every month, they have less than 1 million shillings in their accounts. Okay, so it tells you something about the dynamics around the economy and the work that has to be done beyond the narrow definition of access to accounts. It means underlying economic activities that support inclusion should be where the focus is. And so as we use technology, as we address costs, as we address issues of security to these systems, we must deal with the underlying economic activity. We must understand the value chains down there. What are the economic activities down there that reach the lowest man? How do we follow that chain and put a financial flow to it? Who are the partners we work with to deliver that? How much investment has to go in literacy so that we educate people, we take away their fears, we address risks adequately so that financial inclusion is embedded. What policies will speak to drivers that can address those particular constraints? I know I'll speak to policy later on, but those are some of the focus areas that we should see and what structures work best. I remember last year's conference, we were speaking to agriculture, and we traced the history of the strength of cooperatives. And we were just talking, that means a structure at the lowest level. So what frameworks can deliver these objectives of financial inclusion? And I think I'm looking forward to further discussion on that subject area this morning. Thank you very much.
Thank you very much for that. You talked about cooperatives, and I remembered that in the papers we just saw Masaka Cooperative Union getting money after 20 or so years of asking. So it's very crucial that when we talk, the things we discuss here evolve or result into something. And now that we have got Dr. Sonko on board and a number of distinguished listeners in the audience, hopefully we can advance everything that we talk about here today. Having said that, the statistics you quoted are the statistics we normally hear. Number of accounts, as was said, the 14.7 that have 1 million on their account, less than 1 million on their accounts. Perhaps it's time, and now I'll go back to perhaps Dr. Sonko and Wilbrod. What is the thought about then beginning to track transactions as opposed to, and coming out in the open to say, yes, 14.7 had less than 1 million, but then how many of those actually transacted? Is that something that, as we think of financial inclusion, because then Wilbrod, the banks are the source of this information, is this something you think would be useful for policy change?
Absolutely. And I think you heard Peter, if you heard him very carefully, he said beyond just balances, transactions matter. I think that has been proven more real in the space of fintechs, but more importantly, in the space that the MNOs are playing in. There is a revelation that is very clear to all of us now, that in spite of people having little money or small balances, but the fact that they can keep transacting, if I can keep sending some little money to the person at home, down back home, to the people to do whatever they are doing in whatever little way they are doing it, and that millions of us are doing that, it has a huge multiplier effect across the economy. And this speaks to the numbers that we see the MNOs turning over in terms of mobile money transactions. Millions, trillions, going in trillions, and growing and growing and growing. And that helps the economy. It has also revealed that there is a lot of money, however small it is, but out there in its small size, if it is moving and moving, it is multiplying and driving economic activity. The business models today are really changing, and transaction volumes matter quite a bit beyond just aggregate balances. It means that people can then do business in whichever small area they are in, buy, sell, move money, and facilitate activity. And that is an important indicator.
Thank you, Wilbrod.
Goretti, if I may, can I just supplement what Wilbrod said?
Yeah, please do.
So through the lockdown period, the association was staying in very close touch with all the different members of it. And we noticed a very interesting trend, and it really points to the structure of our economy and how people earn and spend money. So in March and April, when there was a total lockdown, many of the fintechs that carry out, that have agent networks or carry out aggregation services, noted a significant drop in transactions. Now, this is unsurprising because all the small businesses through whom we work were not open. But immediately the lockdown started to be eased, we noted a significant ramp up in transactions, even as the economy is still quite slow. What that pointed us to is actually, it's not about, what as Wilbur said, it's not about the balance. It's about the ability of someone to come into town, to do some work for the day and buy that airtime of 3,000 or 4,000 shillings, and pay that utility bill, and pay for that GoTV of 15,000 shillings. It's not about having the balance on the account. Indeed, we've noted in the last survey we carried out at the end of last month, many of the fintechs that work through agent networks have actually noted that their transaction levels have already surpassed where they were in January and February, because actually it is about people being able to spend money on a daily basis.
Thank you very much for that addition, Peter. And I think in addition, you could say, you've heard it, that cash flow is more important than a certain sum of money, even for businesses to survive. So I think tracking transactions could also almost directly speak to cash flowing, if I may say so. Having said that, Peter, and we can talk about it a little bit later, there are some people who actually have mentioned that, in fact, there may be people who could have been able to transact from home, but they waited for the lockdown to be able to move, and yet they could have actually transacted from home. So we'll park that there because I think we might have a little bit of awareness issue at the same time. Now, let me ask a question on the vulnerable. Every time we speak about inclusion, we seem to focus on the vulnerable groups, the rural, the youth, the 15% that are financially excluded. In fact, there is the term financially excluded, 15%. It would imply almost that the 85 are included. But what fresh perspectives to disruptions such as COVID-19 what fresh perspectives are brought by disruptions like this? Rashmi, maybe you want to talk about that?
Sure. Thank you, Goretti. Great question. So I will go through some of the analysis that we did before COVID and the data that we've collected during COVID to answer that question. And for those who are listening in, that data is available on the FSD Uganda website if you want to download the entire presentation. So a couple of things. First, what COVID or a pandemic of this nature has revealed, as Will Broad and Peter and Dr. George mentioned, is the financial fragility of the lives of Ugandans. Our analysis showed that 85% of adults would not be able to sustain their existing lifestyle the way they are living today. With a 15-day lockdown. And we went into lockdown for way more than 60 days. The second is, as Wilbrod mentioned, 75% or 3 out of 4 adults live in a way paycheck to paycheck, meaning you may not be even formally employed, but you are struggling to pay all your bills on time, which tells you a lot about their financial lives. The third thing that we realized is that the median, when you talk about financial inclusion or the range of financial services that we all need in our lives, you're talking about savings, you're talking about borrowing, insurance, payments, and then long-term pensions, etc. If you look at just savings to understand how much buffer people have, the data showed that at any given point in time, people did not have more than 5,000 or 4,800 shillings in actual liquidity at any one given point in time, as a median, not as an average. The second thing is that most people, 35% of adults, save in semi-liquid assets like your poultry, goats, etc., that you would hope to appreciate and then sell when you need it. In a pandemic, that's not possible. Even if you had very great semi-liquid or illiquid assets like a property, in a normal situation, you may be able to find a buyer. But in a situation where there is a countrywide and a global depression, if I may call it so, then you are looking at distressed sales because you just don't have cash flow or liquidity, which significantly compromised everybody's financial position as individuals and as businesses. Now, what does this tell us and what are some of the disruptions that we should look towards is there are a couple of positives that came out of this, big learnings at a very steep cost, but learnings nonetheless. One is generally when you talk about technology, there is a curve of adoption. A majority of people were forced to adopt. It was like a shock to the system and people adopted because there was no other option. Let's talk about market vendors. Let's talk about small businesses that started putting business inventory online and partnering very quickly with e-commerce platforms, and some of which are FinTech, FITSPA members. They were the companies that saw a rapid uptake in their services. The second piece was around banks. A lot of banks, and including tier 3, tier 4 institutions, saw that most of members, because they could just not move in a lockdown, started taking advantage of internet banking or other types of solutions. Unfortunately, majority of the Ugandans bank, save, or lend in the tier 4 space, most of the tier 4 institutions where you're talking about SACCOs, credit only MFIs or cooperatives, they are not as digitized or could not adapt, which meant that most people could not access their savings or borrowings or even make repayments on time. Hopefully, that's a lesson learned for the tier 4 sector. And as FSD Uganda, we are supporting the regulator and the tier 4 sector to digitize and build long-term economic resilience. And the last point I want to say is, now that we
Rashmi, we seem to have lost you. I don't know whether it's me.
It's not you, we've lost her.
Okay. Rashmi, if you can hear us, we've lost
and
you.
also, how do we support businesses? So
Rashmi?
I said, and also, how do we support? Hello, can you hear me?
We had lost you.
Is this better now?
Yeah, it's better now. I think your last point was
Hello?
digitizing.
Okay.
Your last point was digitizing tier 4s.
Yes, and I think the point I was trying to make is on the long-term economic resilience. So it is a combination of how do we do that with the financial sector, but also how, as the financial sector, can we help in the digitization of produce, of goods and services, and then leverage that what we have learned through e-commerce and others to enable people to grow their businesses and livelihoods. So that was the point I was trying to make.
Thank you very much. I think you have ably answered that question. I don't know if anybody else has something a little bit to add. Okay, let's now talk about policies. Can we share some of those policies that seem to be speaking to inclusion and how they are working? I'll ask George to speak about that.
Yeah, thank you. I hope people can hear me now.
Yeah, we can hear
Hello?
you.
Yes.
Oh, okay. So, of course, the issue of policies, as I said when
we will
struggle.
No.
Yeah, okay. So the issue of policies, as I said at the very start, remember I talked about the aspect of issues to do with financial stability. And of course, we are talking about new products, new spaces, and new, for lack of a better word, new dynamics. So the first thing that comes to mind is an area where I work at the same time. The issue of how do we get protect consumers in this space. And of course, probably Peter will tell us a little more in terms of what security platforms they have, the physical infrastructure. But one of the things that comes out clearly, as the various speakers have said, that in terms of consumer protection, there is a lot of work going on, of course, to protect the consumers, most especially the vulnerable. Because when we talk about vulnerability, we talk about 8% who are excluded. But vulnerability is spectrum. Vulnerability right now is probably systemic because everybody has been hit by the lockdown, and probably only the 480,000 who work for the state are the ones who are more or less assured of their income because probably their salaries have either not been reduced or they have not vanished completely. So in terms of vulnerability, in terms of policy, what consumer protection mechanisms do we put in place when such shocks arise? Because this is a shock that affects everybody, but these shocks also come in form of, say, health-related aspects that wipe out people's savings who don't have appropriate insurance products as and when they are faced with these shortcomings. So probably in terms of pushing the work that you have done in that space is how do we get people to actually start using these digital financial platforms to actually take on other, diversify their financial products that they are consuming over and above things to do with savings, over and above things to do with probably credit. And that speaks to some of these other aspects of insurance, microinsurance, that the people in PIPS are trying to develop and actually push across. So one of the policy areas that comes to mind in that space is, of course, the issue of consumer protection to safeguard the financial consumer. But as I said, that is only the demand side. You also have the supply side. We have to face reality. Commercial banks have their balance sheets, and given this shock, clearly their assets are probably not returning what they had expected on their investment. So one of the things that comes to mind is, of course, how do we leverage what we have at the central bank and even at the Ministry of Finance? How do we leverage fiscal policy and others? How do we get the budget to get to the people or to stimulate that economic activity so that these financial services providers can start to get the deposits they require to actually have that multiplier effect going? And of course, on our side as a central bank, then the monetary policy comes in as a temporary stopgap measure. Because now that most of the loans are being rescheduled and probably they are not getting any incomes, then that means there has to be a liquidity facility to try and buffer that temporary lack of returns on the investment of supervised financial institutions so that we can continue. So I would look at it from the two spaces that on the supply side, we need to protect the infrastructure, the supervised financial institutions, and all the other institutions remain in place, remain functional, because without them, then you don't have that role of financial intermediation that is key in ensuring that the finance moves from the financial services to the real economy. But also on the side, we need to be able to protect our consumers, with, of course, the knowledge itself, but also in terms of our product design, that we actually do not use the disruption to actually push them against the wall and inhibit their economic mobility.
Thank you for that, George. Unfortunately, it's yes. Is this Rashmi? Yes, please. Yes.
Okay, I don't want to block Wilbur, but I wanted to make a few comments to what Dr. George mentioned. I do think, and I would love Wilbur's opinion on this as well. I completely agree with what Dr. George mentioned, but I do think that we need a dose of reality and we need, because if we're not honest with what because we have fantastic policies. There is no question about that. A lot of challenge happens in translating those policies, in execution of those policies, and the enforcement thereof. And I feel that that's a conversation that needs to also be discussed. For example, FSD Uganda did a recent study, mystery shopping on consumer protection aspects around credit provided by financial institutions, tier 1 to tier 4. In 3 districts in Uganda, there were 113 branches of varying types of institutions, and there were, consumers, enumerators who acted as consumers. There were mystery shoppers of credit. And what we found is that only 50% of loan officers actually explained the cost of credit to the consumer. Only 53% explain what the effective interest rate is. And let's all understand that most people do not understand interest rates. They don't understand what it means, how much I am paying you back. Very few people get it. And in fact, the key facts document, which is necessary, that goes with a loan application, only 6% of the loan officers actually shared that with the mystery shopping borrowers. So the question then is, we have all of these fantastic policies. What are the incentives and how are we trickling them down to all the way to the level of the credit officer or the loan officer to make sure that we are thinking of this in a way that is consumer centric? Because if people don't understand how much the cost of credit is, most likely they are not going to repay back, or once they realize it, they will feel that they just don't have the capability. Because if you understand how much you're borrowing, then maybe you also have the option to decide whether you want to borrow at that rate or not. That is one point regarding consumer protection. And I'm sure Wilbrod will respond and hopefully give more insights into the banking sector. The second question is, even before COVID, private sector credit to GDP, while it did increase and has been increasing, is insufficient. And most of that private sector credit to GDP is going into the sectors like construction or others, which it should, but it is not going necessarily to agriculture, but that's where most of the employment is. And it would be helpful to understand what is it that all of us, including FSD Uganda, should be doing differently and support some of these national development objectives that are being set up by the central bank. So, sorry, over to Wilbrod.
Very passionate. Wilbrod, please.
Rashmi is very passionate about these things, and I like her energy levels. Luckily, we agree on many things. Let me first say that, Goriti, there's a national strategy for financial inclusion at the highest level. This was launched in October 2017 by the third Deputy Prime Minister. And it is anchored at the political level in the Ministry of Finance. The Secretariat for National Financial Inclusion is Bank of Uganda, and below it, they are implementing partners. And financial institutions are key major partners for driving financial inclusion. Now, like Rashmi says, the Air Policy Framework's wonderful strategic plan, but at each of the various levels and layers, translating those policies or executing the things that need to be done to bring this to reality has had certain areas where they fall short, and I think we need to look at those and work on them. Let me start with the highest level, which is at the policy top level, at the ministry level. Again, sometimes when these are written, other would-be supporting policies can contradict that strategy or indeed constrain it. You know that financial inclusion, among others, is riding on technology quite a bit. As I said earlier, has enabled access, has enabled reach, is even addressing issues of cost. What advantages, what incentives do those who invest heavily in technological infrastructure to expand reach, what incentives do they get? Either from a tax or fiscal policy point of view, or any other incentive. And once another counter policy works against that, it defeats the objective of financial inclusion. And then, of course, the central bank has its roles, of course, works through monetary policy, and of course, since it has oversight over financial institutions, it exercises that authority to direct interventions. And then the financial institutions themselves, again, the survey by Rashmi indicates areas where we fell short. We got that report, and together with Dr. Sonko's department in Bank of Uganda, we are working to make sure financial institutions really explain as much as possible to customers. I mean, that speaks to financial literacy by itself. There are numerous other players, the aggregators, the fintechs are enabling many things and enabling interoperability, they're enabling reach. How do they play in this? What benefits do they get? How can they be well supported out there? Government agencies, just like, let me give you one example, NIRA, that is responsible for our national identity records so that we can authenticate who is actually transacting, so that we can get more people into the system, we can authenticate transactions. How fast do they respond to the needs of the industries in enabling access to this information so that we verify who we are dealing with in extending financial services? So at a policy level, it is good that periodically we review where have we fallen short across the various implementers, what do we need to do better, and how can, most importantly, how can we coordinate it properly so that we are moving in one direction and one action is not working against the other. How do we ensure there are networks across the country? We have seen over the last 2 years of agent banking, there are agents who have been approved, but they have not transacted because there's just no network in that particular remote area. Not that those people don't need services, but there's just no network. However much you train them, however much you are willing to work. And so those are some of the underlying challenges. It is a good time to review these policies. It is good to review the implementation by different parties, call for help, and there are numerous partners who are willing to support in this particular area. That said, Goretti, there have been milestones. We are not where we are 5, 10 years back. There is a survey that was done, and I think it's anchored on the age of our population. And it confirms that our young people are hungry for technologies. They are hungry to adopt new methodologies, new access channels. They are happy to jump on and embrace these various channels of delivering financial services. And therefore, the uptake can increase if given the right conditions. So I think I'm saying the environment is very right. There is work for us to do, but it is also good to look and ensure that policies and subsequent counter policies do not work against the main or policy objective. Thank you.
Goretti?
Yes, Pete. Yes, George? Is that George? Peter or George?
I think it's George.
Yeah.
Okay, George.
I just need to say something and
we have lost you, George.
Oh, can you hear me now?
There, just stay there. Don't shake, don't change, don't turn.
It's the window.
Okay, I won't change, I'll just speak. So, two issues that come out clearly from what you brothers have said. Indeed, we are not where we were 5 years back, because as Zolbrod will tell you, we've done a lot of work in the space of consumer protection. Of course, both in terms of preventative, but also in terms of curative. What do I mean? That yes, FDs, when they carried out the mystery shopping, probably there were issues, but there's been a number of interactions with the supervised financial institutions in that space and engagement, and I am very sure probably we shall see the results of these engagements 12 to 18 months from now, whereby we've actually walked through different field officers in different regions of this country, and I'm very sure we shall see a number of things happening in that space. In terms of the curative, some years back, probably people didn't have the redress mechanisms in place. But today, there is no Bank of Uganda supervised financial institution that you'll find that doesn't have an internal redress mechanism. And even then, when you come back to the central bank, we also have another position whereby if a customer is not satisfied, they can.
We have lost you. Technology has taken you. Totally.
Sorry. So what I'm trying to say that there's been a lot of progress in the preventative.
Have you shifted from the window?
So, he shifted. George, I think I'm going to request you that you write something.
No, okay, please.
Okay. So friends, I would like to take you a little bit back to the aspects of financial inclusion, that is awareness, access, breadth, depth, usage, affordability, universality. Where is the focus for legacy institutions like banks right now? Where is the focus? What could be done better? Wilbrod, that is to you. And I would also like to hear from the fintechs. What are you doing about those different elements? Access, I think we've all agreed access, we are doing our best, and we should not be talking much about that. What's the next thrust? Where should the next thrust be?
Thank you very much, Goretti. I think for us in the financial sector, the issues around breadth, depth, usage, affordability are important things, so that even from the little journey we have moved, we have thousands of agents across the country now, coming from just less than 1,000 branches a couple of years ago. we are going to the 13, 14,000, and we are increasing. That is just agent points, but there are numerous electronic channels now, wallet accounts, there are internet banking, and so on and so forth. We need to increase our pace in developing products that speak to the needs, specific needs out down there. We no longer just need to run generic products, but products that speak to sectors, to customer segments that we are looking for down there to ensure financial inclusion objectives are achieved. And I think you can see that our membership is doing this. That's why you are seeing digital lending in partnership with partner A, B, C, D. We are developing interesting products. The western part of the region, for example, is known for growing matoke. We've structured something as simple as a matoke loan that understands the cycle of matoke, who are the players in it, where is the market. Kampala is ferrying matoke every night and day from Barara, trucks, huge gardens. What are the dynamics in that value chain, and how can we finance that chain? We do that if we replicate it across the economy and regions, and finances flow that can support those value chains even at that level. That has more impact. This morning, I just finished a call with Bank of Uganda, and we're asking them to ensure that the other lower tiers are facilitated to join the shared agent banking framework. Why? Because we want them, they reach the lowest mile, because they are based there, they understand the dynamics. So they reach the people on the one hand. Secondly, it is easier for us to extend credit to such organized groups, and they in turn pass it on down. So in the area of breadth, depth are important aspects. We can't run away from the second thing, to issues around affordability, so that these services are affordable, and indeed they allow the businesses draw margin. And I know how controversial that subject area is. But what are we doing as an industry is to tackle the things that drive cost and make it expensive, so that we can deal with them or use and employ and run on things that make it cheaper, whether it is technology, whether there are policy issues that signal flow of money elsewhere, where there are regulatory, administrative constraints and burdens that make the delivery of financial services more expensive. What are those things that we can do? And to that end, we started with Bank of Uganda last year and constituted a team for regulatory reforms for banking operations, so that we look at those things that constrain banking and make it expensive. That team is working, again, thanks to Rashmi's team, who are supporting us with consultants, so that we look at those areas that can free banking of certain burdens without us compromising on risk and security, so that we make services affordable and reach people down there and achieve the objectives of financial.
All right, thank you very much. We brought, now I would like to ask a question to Peter in particular. Peter, what technological innovations can players use to deepen financial inclusion?
Okay, Gority, before I answer the innovations, I'd just like to speak a little bit about policy and what thrusts the regulators might need to think about. Now Wilbur has spoken very well about access and how working with fintechs, the banks are increasing the access through agent banking and things of that nature. I think one of the key things that is missing, and despite the progress that has been made with the financial literacy campaigns by the Bank of Uganda, and the banks, of course, we need to critically think about how we're going to drive digital literacy. Now, and this relates to your question that you parked earlier about why didn't people transact from home? Now, there are 4 or 5 technologies that bankers and supervised financial institutions really need to be paying attention to. The first is cloud computing and what it can do for you. So in relation to the discussion we're having on business models, I know there are various legacy systems, there are branch networks that have been invested into, etc. But many of the fintechs that are working in Uganda can actually support many of the banks to adopt some of the cloud-based technologies. For example, there are fintechs that are doing some very interesting things around short and long-term investment solutions that we really need to pay attention to. The second is data analytics and what opportunities open up for that. Today, there are digital lenders in Uganda, in Kenya, that can develop dynamic credit scores for small businesses, for consumers, etc., and give a loan between 2 to 5 seconds from the time you apply for the loan to the time it's disbursed. We really need to pay attention to this because the reality is these digital lenders are most likely serving the customers who we think that financial inclusion, that need to be financially included. If we don't pay attention to that, we're going to continue as an industry being disrupted. The third is we need to think critically about the infrastructure and how we can share it. So today, if you walk into one of the shops, supermarkets, you will often find 3 or 4 different POS machines, point of sale machines. One from one bank, another from another bank, and yet you have one card. And it is often left to the shop keeper to decide which machine is used. Now, those are investments that are going into building out this digital infrastructure. We really need to think about, does every bank need to put a POS machine in the supermarket? Are there ways, and as an industry, for us to really think about, okay, how can we drive the cost down for consumers? How can we drive the cost down for these shopkeepers by sharing infrastructure? Now, there was a very interesting initiative that was started by the EBA a couple of years ago, and Wilbur has spoken to it around agency banking. We need to support these sorts of initiatives so that we can really drive the benefits down to the consumers. The last that I'll speak about is blockchain. Now, most of the participants here today will have heard the word blockchain. Unfortunately, most of you will also mostly have only heard about it in relation to Bitcoin or cryptocurrencies. There are other use cases for blockchain, and we need to really understand how these can be used and how they have the potential to disrupt or change the future of financial services here in Uganda, across the region, and across the world. Thank you. Goretti, I'm not sure if you're coming in now, but we can't hear you.
Goretti?
Yes, sorry about that. I was having a bit of a challenge here. Yes, I'm back. Thank you very much for that. You've raised, there is very many action points coming out of here. I'm sure Wilbrod has had, and because of time, we may not even be able to speak to each of them. It just shows how much work we still have to do as an industry, especially in engaging and coming up with solutions to everything that we are talking about. I would like to ask Rashmi, what role could financial inclusion play in economic recovery from disruptions such as COVID-19?
Sorry, Goretti, I lost the last part of your sentence. Can you still hear me?
Yes, I can hear you. What role could financial inclusion play in economic recovery from disruptions such as COVID-19. And I'm asking you because of all this research that you're doing.
Okay, that's actually a tough question because it's not just financial inclusion. So if you allow me, I'm going to borrow a lead from what each of the panelists have said, right? So if we are looking at how do we rethink or reimagine when we are building it back up again, then I would like to borrow a couple of things. One, first, let's understand different segments of the population. Not everybody needs the same solution. So at FSD Uganda, what we did, we worked with the Ministry of Finance and said which segments of the population are more likely to recover from this economic shock than the others. Assuming that we have a stimulus package that reaches micro, small, and medium businesses, which are responsible for 90% of the employment in this country. Now, what we realized is that assuming that stimulus packages reach, then the agriculture sector, which will still suffer from lag effects of a pandemic, has the potential to recover in 18 to 20 months. You will see manufacturing also that could also has the potential to recover quickly, depending on how imports and exports shake up. But you will have micro traders, especially young women, women traders who do very small owner-operator businesses, whether you're in transport, whether you're in trade, or if you're a very small business in hospitality, you will not recover to pre-COVID levels of where you were until 2020. Like, it will take you at least 2.5 to 3 years to get to where you were January 2020. And that's the reality that we are struggling with. Now, you couple this situation, which is on the demand side, with what the supply side is facing, which is the financial sector. Will Broad knows this way better than I do, so I'm not even going to attempt it, but significant portion of UBA's member banks had to restructure their loans with their borrowers. Which also means that we don't know how many, first and foremost, the financial sector is trying to see what they're on a wait and watch. They're A, restructuring the loans with their borrowers, B, trying to understand where the risks truly are, both perceived or real. And then they're holding on to liquidity because most people are going to withdraw their savings for varied reasons. They're drawing down on savings. Several people have lost their jobs or are on furlough, meaning that they are not getting paid. And this is creating serious complication. So there are a couple of instruments, the burden of this has to be shared collectively. There are a couple of instruments that the government is already thinking about, apart from tax rebates, tax incentives, or forgiveness, or giving a longer duration for people to pay certain types of taxes. There is also a significant thought being given to stimulus packages and liquidity facilities that can help small and medium businesses. This is separate. What I'm talking about is separate from what the regulators like the central bank and UMRA have already done for for the institutions that they supervise. And unless we have that can help, because this injection is necessary to jumpstart the micro and small medium businesses that are significantly suffering. And I'm going to submit that there, because I'm looking at this in two parts. One is we need something to happen right now, immediately, and then we need to build back better by investing in medium to long-term solutions like Will Broad and Dr. George and Peter mentioned, that includes technology. That, for example, if you had to ask the Uganda Microfinance Regulatory Authority today, which is a very, very nascent and young regulator, how do we assess the stress levels of some of the large SACCOs or BSLAs or credit-only MFIs? It's a challenge, and the regulator wants to do that, but most of these are not even licensed, because this entire we are all as a country trying to formalize a bulk of this segment much later, because this segment already existed. Most people still work with SACCOs and BSLAs. In fact, the Association of Microfinance Institutions, which is an industry body, has existed for a much longer time than the regulator. So I think it is upon all of us, and when I say all of us, I include FSD Uganda and development organizations, to help both the government, the associations like the Bankers Associations, FITSPA, AMFIU, as well as the private sector, in saying, now that we know what we know, let us use technology, let us build it in a fashion that if we had to suffer in a worst case situation like this ever again, we are able to still continue business, we are still able to service people.
Thank you. Rashmi, are you still there? Thank you very much for that.
Yes, sorry, yes, that was my submission.
Okay, thank you. Thank you very much, Rashmi. We have run out of time. We thought that we'll do maximum 2 hours, and we have only 16 minutes to end. We had a number of other questions, but we shall park them. Allow me to now ask you some of the questions that the participants have asked, so that we can quickly end. One of the questions that has come through is for you, Wilbrod. Charles Kimboa asks about the fraud at agencies. What can be done about them? How does UBA plan to handle frauds at agency level? Hazel Mugabe asks, basically the 14 million accounts drive transactions, fees, and traffic to the banking platforms, but they bear the biggest brunt of the costs. It would be interesting to see their contribution to the industry balance sheet. I think that's to you, Wilbrod, again. Then Lambert Ndiabahika, actually an associate at the Institute, is asking, please comment on the effect of mobile tax and OTT on financial deepening and financial inclusion in Uganda. I think that might have to come to you, Rashmi. Then Agawa Innocent is asking, and Agawa, I think Agawa works with the Microfinance Support Center, and they would have added a lot of value to this discussion. Hopefully we can get another time when we speak with them. Most of the panelists have focused on defining financial inclusion from a perspective of what it was envisaged to be. But given latest changes in the world, especially COVID-related disruptions, how should we define this now, and what needs to be done to achieve the new desired state? I think a bit of work has been done there in discussion, but Peter, maybe you could just say something small regarding to that. I'll repeat it. We have described it as before, COVID-related disruptions, etc. Given those, how should we define this now, and what needs to be done to achieve the new desired state? The other is from Tony Bagalanyi. During this situation, how can we help saving groups like SACCOs to do everything online payments? I think you've talked about that, Rashmi. We've said that all of us have to work together to see how we can digitize the platforms and the tiers where we have most activity. Lastly, and this is to you, this second last, to Rashmi. What is the business philosophy of FSDU? What guidance is there for an innovative investor who would like to extend credit at, say, 36% compared to 60% or 120% per annum? Rashmi, answer to this. I don't know whether 36% is something that you think the market could take. Please advise that investor. And then the last one, Fiona Nwamanya, is there a strategy to drive up more uptake? Sorry, I think that wasn't very clear. Yes, she asks, the delay in the release of CRB regulations has limited the breadth of data that can be used by CRBs to develop inclusive credit scores from alternative data sources, which would help address key barriers to the attractiveness of credit and from credit sources. Can BOU develop a framework on alternative data usage besides the credit from the SCPs in aiding financial inclusion. I think this one will go both to, let it first go to Peter, because I think, Peter, you just told us about interesting solutions from fintechs. So should it be CRB, should it be fintechs? And then George can also answer. Friends, I think that's where we'll close it. Please answer as quickly as you can so that we can end this session. Thank you.
Thank you. Thank you very much, Goretti. A couple of questions. One was on the fraud at agent points. What are we doing? How are we seeing it? Obviously, the agent channel, banking services delivered through the agent channel, it's relatively new, 2 years. We are like a 2-year-old baby in that space. First of all, there was a lot of training for the agents themselves in terms of financial transactions, authentications, identity verifications. Nonetheless, fraudsters work 24/7. And it is important that we are alert and remain alert all the time. UBA has a fraud committee that every month reviews fraud incidences, whether actual or what we call near miss, and the circumstances surrounding them, so that we put together control measures either to minimize or completely detect and stop them, and lessons learned in every case. We also do anticipation to strengthen the fraud control framework and share this with agents regularly. So it's a very, very continuous process. Fraud is not just in agent banking, but even in the mainstream industry as well. We are also working with NIRA, like I said, so that we can verify identity electronically and speed up any risks of fraudulent behavior. Most importantly, fraud is controlled when we are all aware. The customer is aware, the agent is aware, and of course the system controls that facilitate transactions. We also work with the police. We have been doing a lot of training and sharing with them to educate them about fraudulent type of transactions, so that we strengthen their investigative capacity, but also capacity to prosecute once confirmed. So it's a continuous effort. It requires many parties, but above all, awareness at all levels. The second question was about the 14 million and their contribution to balance sheet. They certainly contribute. Revenues for financial institutions are twofold. One is interest income from lending, and then what we call activity fees. So the more they transact, as my colleague Peter said, the important thing today is not just looking at balances, but transaction volumes. Even if I have 10, 20,000 shillings, but if I transact and share it 4 times across the system, I'm adding value. So they certainly contribute. Fee income compared to interest income is in the range of 70, 30, 60, 40% in all bank incomes today. But this is a growing number, and as you understand that the payment space is about transactions, these numbers are increasing. So the point I'm making here is that we value every customer, however small. We only just encourage that they continue to transact. What is the strategy to drive uptake? Again, awareness. I think Rashmi mentioned it, that during the COVID, even those slow people in uptake were forced, because there were no alternatives, you were not allowed to move. So in a way, some of these things, I don't want to say COVID was a blessing, but sometimes these things present a shock, and you have got to be forced to embrace alternative channels. It's not a good way to do it normally, but I think we must continue investing in the benefits of alternative channels. The last question I want to talk about was the delay in CRB regulations. Very, very valid comments. What the person is saying is that in evaluating the possibility of lending a person, there are numerous data sources for which you can gauge a borrower, apart from the traditional ones. And those sources of information vary. They could be something as simple as how regularly you pay for your water or electricity bills. Can probably tell me that this person is a good borrower because owners' payments, when they take services, they pay for it. The CRB regulations were meant to provide an open up to allow for other sources of information. It was also meant to allow fintechs develop tools for scoring in lending. There has been a delay in putting across the necessary legislation or regulations, true, and it is constraining credit. We have had meetings. We have a CRB committee, and we meet with the central bank one as well. We have engaged them so that we try and fast track it, so that it can open up the opportunity space in the lending environment, and we look forward to having that quickly concluded. Thank you very much, Goretti.
Thank you very much, Wilbrod, for that. Peter, you had something to add to that, very briefly?
No, actually, I think I'll just go straight to the questions that were asked of me. There was a question about redefining financial inclusion. Even in light of COVID, I believe the new definition that we have talked about at length today still holds. It's not about having a bank account or having access, but it is about usage. Related to that question, he asked, how can we drive this usage? Again, we've spoken about it at length, and Wilbur was just mentioning awareness. But on awareness specifically about, consumer protection and safety. If I'm using these digital channels, how do I stay safe? If I'm using this agent channel, how do I stay safe? The second way is to ensure safety of systems, and I think that responsibility lies mostly on the providers. So I'm talking about fintechs, banks, etc. We need to ensure the safety of our systems, and we need to do it in a globally recognized manner. And then lastly, we are really eager to see what will come out of the NPS regulations once released. We believe that increased regulatory oversight of the fintech community will help us to drive partnerships and increased collaboration between the supervised financial institutions. It also will drive trust amongst consumers once they see that a fintech is being regulated by the central bank. Thank you very much.
Thank you very much, Peter, for that. And to you, Rashmi.
Sorry, I'm on mute. So I'll just go straight back to the questions that were asked. And Goretti, I tried seeing if I'm able to see all the questions, but I couldn't. So I might just need your help in the second question. So the first question was around mobile money taxation, if I remember that correct. Is that correct? Was it just around the taxation
Yes.
and the implication on financial inclusion?
Very much so.
Okay, yeah. So the honest answer to that, I'm not going to speak for any government to raise revenues. It's not.
We lost you, Rashmi. Rashmi?
Taxation and the implication of mobile money tax. The truth of the matter actually is that when you look at the bulk of the mobile money transactions, they have tiers. Most of the volume of transactions happen in the lower tiers. These tiers are largely price inelastic, meaning that even if you increase the prices as MTN or Airtel, forget taxation, the volumes don't reflect the drop. The reason being is people in those tiers don't have a lot more other options. Like they don't have bank accounts or other types of wallets that allow them to then figure out substitution or different kinds of alternatives. People like me, the panelists, maybe people like attendees here, we are the kind of people who have options. The minute during COVID, MTN and Airtel, along with UBA, worked to make bank to wallet, wallet to bank free, we started moving large volumes across both our channels because people like us have both mobile money accounts as well as bank accounts as options. So we are more price set. We know how to hedge and optimize our resources, whereas people at the bottom of the pyramid who largely form the large volume transactions, not value, they are stuck. So even if tax happens, even if price increases happens, they pay what a lot of development economists call the poverty penalty. So that's the answer to the first question. Sorry, I don't remember what the second question was. It was about FSD Uganda's business model. I'm not sure I was very clear on that.
Yeah, the person was asking what is FSDU's business philosophy, but I think you you ably talked about that in the beginning when you said what you do. The other one was they need guidance. If there is an innovative investor who would like to extend credit at say 36% compared to 60 and 120 per annum, what advice do you have for this person or guidance?
Well,
Yeah. Lost her.
I think we've lost you. Rashmi?
can you hear? Sorry, it's heavily raining. Hello? Hello?
Yeah, now we hear you.
Hello?
Now we hear you.
Okay. Okay, so my response is, first and foremost, please make sure you have a license. You can get a money lender license from UMRA if you're in money lending business or just credit only businesses. And if you're a technology company, please join FITSPA and become a paying member so you can use the breadth and knowledge of FITSPA and its membership. The second piece is, if what you're saying is that you're going to give it a 36% annum and therefore you're competitive compared to other credit-only institutions, go for it. The idea would be just figure out how to go to market, how to position yourself and position your product and make sure that people realize that you're better than other offerings out there, because credit-only business model is actually pretty expensive because you don't have any other way of reducing your cost of capital.
Okay, thank you. Thank you very much, Rashmi, for that. And I think those were the questions. We'll only request, yes, I'll only request you to answer one final question that's important for everybody here. Now that we know what we know, what would we do differently, especially at employee? Because we've talked about institutions at employee level and at a personal, individual level, and a person who is also a user of financial services to be included. What should we do? Employees and individuals. I'll start with you, Peter.
Thank you, Dorothy. So I think I spoke briefly about user disruptions and innovations is significantly going to change the way supervised financial institutions carry out their business. And they may be a direct result, a direct impact on how you work and how you engage with customers, etc. Now, we're speaking to the Institute. Goretti, I know you knew, and these discussions have been taking place since before COVID. And we're planning to roll out a series of engagements with the UBA and its members. These intend to be collaborations between FITSPA and UBA, allowing us to share a lot of information about what's happening between ourselves. For example, banks have a lot they can teach fintechs about compliance, regulation, risk management, etc. Similarly, fintechs have a lot they can teach bankers about some of these technologies that I was mentioning, about cloud computing, about data analytics, etc. Through this series of engagements, we intend to both build the capacity of each other. With the regulation coming out for fintechs, with the increasing dynamics of consumer engagements, business models, etc., I believe this would be a very, very good opportunity for us to build this market together, but also address some of the challenges we're having on financial inclusion. Thank you very much.
Thank you very much, Peter. You seem to say that there is a role for UIBFS to do there as an institute, and I will take it that your question has been representative for everybody, and just request I'll request Wilbrod to speak about the role of the institute in this whole inclusion element. What do you see? before we can close this?
The role of the institute. Certainly, the institute is a knowledge center, and I think all that we have been talking about, awareness, the education around it, to change users, to change employees, businesses, stakeholders, and I think doing that in the new environment will be important, even under the constraints under which we are operating. And I think the institute is positioning itself for that role very, very well. I think Peter has very, very ably spoken for all of us in terms of security frameworks, knowledge. For staff, our staff in the industry, we are engaging all of them to prepare to work under the changed circumstances, especially on customer engagements. The sector is extremely regulated, as you know, but even within those circumstances and the current COVID, we are saying let's adjust and continue the engagement. Lastly, the industry will be running SME seminars directly to our SME customers of how to cope in these particularly challenging times for the next 6 weeks. So every week on Wednesday, we'll be running a 1-hour session, how to cope, how to engage financial institutions, what are the things to care about, so that we can go through these tough times, but more importantly, to build resilience across our businesses all through. This may not be the only crisis. Perhaps there can be other challenges in the future. Thank you very much.
Thank you. Thank you very much, dear panelists, friends. That brings us to the end of this very insightful session. And maybe before I end, I'll just give a second to George, our keynote speaker today and representing the regulator, to say 1 or 2 words, and then I just quickly wrap up with what I've seen as or heard as the key points for today. Thank you.
Thank you, Goretti. I think I need to emphasize that the regulator with all the other elected now is working on issues of consumer protection because I've seen many coming.
George, I can hardly hear you.
I'm saying that the regulator, I don't know if that's better. Hello?
Yes, now we hear you.
Yeah, so I'm saying the regulator with our colleagues are working on issues of consumer protection because I've seen it coming to a lot. And after this consumer protection covers both the traditional providers of financial services as well as fintech, because even before the asset, the national payments bill, we have the mobile money guidelines of 2013, which look in the fintech into our consumer protection framework. So that should be one of the takeaways of the attendees, that there are safeguards in the system, even as we consume these financial services that can become critical if there are disagreements during disruption. That's my submission on that.
Thank you. Thank you very much for that. And that brings us to the end of this session. We are going to have many more, as we indicated. There is so much to learn, so much to act on, and so much to progress as we look towards having better financial inclusion. Key of the things that I've had, I think the overriding thing has been that we have financial fragility as an economy. I think that's very important. We need to improve financial activity and therefore transactions. We need to have better products that are responding to the needs of the market. We need to allocate our digital infrastructure better, including collaborations where possible, and also supporting the tier 4s and the unregulated sector, how they can digitize. We've talked about regulatory reforms for banking operations, to ease banking operations for inclusion. And then there was a lot that came through what we have to learn: cloud computing, data analytics, and blockchain, and all these things. Friends, there is a lot to act on. Of course, financial capability of our people. There's a lot to act on, and our desire and hope and prayer is that we as the people who have been on this panel can find a way, and including the attendees, can find a way of structuring this into something that can further advise policy, or if not, accelerate policy execution and implementation, especially since we already have policies, but at this point we need some level of acceleration of execution. I would like to say a very big thank you to you all, to remind you that the Institute is able to deliver all training on a robust e-learning platform starting now, to remind you that professional and academic programs are open now. We should be starting in August and to examine in December, and to remind you that we've got an AGM on the 17th, which is the next Friday. So if you're a member, pay up, or if not, register already. I would like to thank you very much and to let you know that you will be receiving CPD certificates to your emails of this webinar and the previous webinar. And to our dear panelists, our thank you is coming. Thank you very much and have a good day. Bye.
Thank you. Thank you very much.
Thank you.